welcome our Chief Guest, Honorable Governor of the Reserve Bank of India, Dr. Raghuram Rajan ji, to deliver the 14th FedBank Hormis Commemorative Commemorative lecture on financial sector reforms in India, the past and the future.
Thank you. Thank you very much for that very warm introduction. Shri Vikamsi, Shri Sham Srinivasan, Mr. Hormis, Mr. Varghese, Mr. Engineer, Mr. Uldadan, distinguished guests in the audience, including our friends from the press. First, thank you very much for inviting me to give this lecture in honor of Shri K.P. Hormis, the architect of Federal Bank. As you've heard, he built a one branch bank into a 285 branch bank in the span of 34 years. Now that seems something from the past. Somebody spending 34 years at a bank and building it up branch by branch in an organic way, pioneering social banking, laying out a structure for agricultural lending which is profitable both to the borrower as well as to the lender, and focusing on the weaker sections of society long before these became national priorities. While I never knew him, I can guess that much of it was about character lending, lending to business people that he came to know and trusted based on a sound analysis of their business proposal, the information that he had, calculated risk-taking based on some amount of due diligence, but ultimately an intuition about whether the proposal would work out. Organic growth, that is not growth not by taking huge projects which would expand the balance sheet tremendously at one go, but small loan by small loan, so that you stick to the knitting, you know what you know, and you move the bank forward on that basis. All in all, a picture of very careful banking which explains why it took 34 years to build the bank up from one branch to 285 branches, but at the end of it, a very solid, very solid nationwide bank. I hope that many of the banks we have licensed today that are coming in will take inspiration from this kind of story and build out their banking networks. Again, brick by brick, branch by branch. Maybe some of them have much fewer branches, but customer by customer, loan by loan, into large nationwide institutions. We are on the verge of a tremendous transformation, not just banking, but more broadly in financial services in this country. And even though, you see global market turmoil spilling over into this country, you see stock markets going up and down, more down than up, you see some concern about bank balance sheets and bank results. I have no doubt that all this will pass, probably sooner rather than later. But the opportunities in the banking system that lie in front of us, tremendous opportunities, the opportunity to connect every Indian to the formal financial system, the opportunity to jointly create value and jointly benefit from the value that is created, will certainly is presenting itself, and we need to take advantage of it. Now, if we were to talk about the future of banking, I just walked through the future of banking when I saw some of the activities that Federal Bank is engaged in. But this is something that we will see a variety of solutions to the question of how to bring in every Indian into the banking sector, how to traverse the last mile to his or her banking account, How to ensure that all the information that we can collect in this modern age can be used effectively and more quickly than perhaps Mr. Hormis could in making sound loans which are carefully monitored and pay back in a reliable way. So I'm going to talk a little bit about some of what is coming. We have to base this on principles such as we need more competition in the banking system. There already is a fair amount, but we need more from a variety of financial institutions so they can all try different solutions to solve the problem of getting every Indian on board and getting every Indian entity, whether it's a huge infrastructure project or a small kirana shop, whether they can get financing. Now, it's not just the banking sector, as I said. We need more participation in our financial markets to increase their size, depth, and liquidity. Of course, given the kind of turmoil we see in the financial markets almost every other year nowadays, we have to be careful about doing it in a measured way. Always moving forward, but moving forward step by step so that we build the resilience and depth in our system so that we're not overwhelmed by the volatility that surges through global capital markets. And we also have to understand that while we focused in the system on mandates, you should do this and you should do that, as we move forward, as our country develops, the way to move lending to where we want it to go, to move insurance to where we want it to go, to create more accounts, will increasingly be by creating supporting frameworks so that banks can go out and willingly do it because they see profitability in it. They see profitability, as Mr. Hormis saw, in agriculture. They see profitability in supporting the weaker sections of society, and it's mutual profitability both gain. And in this process, I think technology can be very helpful in reducing the costs of doing business, especially with the small and the financially weak, and thereby can achieve our needs for inclusion. And again, I would urge some of you to walk through the set of kiosks that have been set up by Federal Bank, reflecting some of the changes that are happening not just in this bank, but across the banking sector in our country. Now let me just highlight some of the areas where we are focused on in trying to bring change. The first place where we bring change is we bringing in more institutions into the banking sector. They're not the traditional institutions. There are many new kinds of institutions that are coming in. Some which resemble Federal Bank. I'll talk a little bit about it, but some which do very different things. So after a decade or so of no entry, we have had 2 private banks enter last year. And this year, as well as the next, a number of payment banks and small finance banks will enter. And we hope to put the universal bank license back on tap soon. Now, of course, one has to worry about whether the competition created by so many institutions is going to be unfair. It certainly is going to be fierce, but will it be unfair? The point is, all these new institutions don't have any particular advantages, regulatory advantages, over and above existing banks in the system. They have no additional privileges or advantages. So in that sense, the basic condition for a level playing field is there. What we hope, however, is that these new institutions, payment banks that can't lend, but can reach every corner of the country through their existing telecom networks or finance company networks, can enable every last Indian to participate in the financial system because they bridge the last mile. But they handicapped relative to the universal banks in the sense they can't lend. And then we have small finance banks. And the word small here is not about the size of the bank, but the entity they're going to work with. We hope they will work with the small entrepreneur, the small and medium-sized farmer. The maximum size of the bulk of their loans is capped at 25 lakhs. So they're not about making huge corporate loans. But we hope these small entities will learn to work with small businesses, understand their needs, in the same way as Mr. Hormis created his bank. They will create banks, and they will thereby serve a sector, the small and medium-sized sector, which has been neglected to some extent in the past. So competition here will help by increasing access, increasing the services to the hitherto neglected, and can create a whole variety of new products that these people can then benefit from. Now, there are reasons. There are, reasons to go this way. One of the clear findings from academic studies is large banks find it very hard to deal with small customers. Large banks find it very hard to service small kirana shops or small manufacturing units. And why is that? It's because typically the person the kirana shop will work with or deal with is a branch manager who's bound by a variety of rules set in headquarters, which may be 1,000 miles away. And as a result, when the kirana shop owner goes in, he doesn't really have a balance sheet. He doesn't have a profit and loss statement worth, which has been passed by an accountant, etc. The loan that is made to that small entity is often a character loan, based on the banker's intuition for whether this is a good credit risk. Increasingly, this will be made based on a variety of other information that is captured by the financial system today. But in the past, these were character loans. It was very hard to make those loans if you were controlled by the rules of engagement given by your headquarters. The small local bank found it much easier because the owner sat inside the bank or was just a phone call away and could talk to you about whether this loan could be made. My hope is our small finance banks that are opening up, because of their ability to connect closer to the small borrower, will be able to make the kinds of loans that we need there. Now, existing banks, of course, will have to adapt to this kind of competition. Yes, certain kinds of businesses will still remain. The businesses to large corporation, the huge infrastructure loans that our country needs, those will be there. We have to do them in a somewhat better way given our past experience, but I have no doubt that we will figure out how to control risks in those kinds of loans. But for the areas where these new entities will compete, there will be much more competition. And therefore, this will put pressure on existing banks, including our public sector banks, to automate more so as to reduce transaction costs, to cut administrative overheads, to do things in a much more efficient way, to improve response time so that the customer who applies for a loan doesn't have to wait 5-6 months before he gets a response. And they have to do all this while improving their risk assessment and monitoring systems, because the spreads they can get on the lending will tighten. They have to do this using the wealth of information and new technologies that abound so that they can do it at low cost. Now, this massive transformation in the financial system, both for new players coming in as well as existing players who are hit by the competition, will almost surely require new talent also coming in. Not traditional bankers. We need more of those, of course, new skilled loan officers, new skilled account managers. But we'll also need a whole new variety of skills in order to deal with the new challenges. HR professionals, IT professionals, sometimes forensic accountants to chase up what happened to a loan account which is going bad. So all this means that our existing banks, human resources is going to become an extremely important part of the challenge going forward. Now let me turn to public sector banks and the challenges that are being addressed with them in trying to improve governance and management. As you know, the government has chalked out a path with Indradhanush on how it will move forward, taking in some small measures from the PJ Nayak committee report. The idea is to move to much more professional boards where a variety of professional abilities are represented, including HR, IT, accounting, etc. And starting next financial year, the board members will be chosen by a bank board bureau, which will be populated by people of tremendous integrity, and it will be a very transparent process of nomination. So this process of selecting board members for public sector banks, to my mind, will strengthen the boards and create boards that are capable of coming up with differentiated strategies, which are capable of improving the risk management that currently takes place. And I think this process is already underway. New board members have been coming on and strengthening the boards as reported by our RBI nominees on those boards. Now, in trying to attract people of capability, people of integrity, professionals, more of them onto these public sector bank boards. And by no means am I casting any aspersions on those who are already there, but I'm saying we need new skills because of the competition that is emerging. In trying to attract these people, we have to figure out how we pay a decent market compensation to board members. So that is something that we have to think about. And if we are really trying to get people to work for government enterprises, we can't rely only on their patriotism. There will no doubt be some people who come and join because of their patriotic beliefs, they want to make a difference. But along with the patriotic, we will get those who intend to profit by their board position in other ways, if not directly. And so that mix of the patriotic and the unscrupulous is something that we have to avoid. Better pay a decent compensation to get good people on the boards who will run the banks effectively. As we professionalize the boards in the public sector banks, as the government professionalizes those boards, it will also, in my view, have to think about decentralizing more decisions to the boards. Boards will increasingly have to determine the strategy for the bank, as well as potentially in the future the appointment and renewal of their chief executive officers as well as their chairman. At some point, these boards will also have the freedom to set compensation structures and performance measures for their senior executives, including long-term stock options. The point here is that if we want the public sector banks to not look uniform, we certainly have to appoint strong chief executives, and that process is underway. A number of them are already running public sector banks. But we also have to empower the boards to differentiate their strategies, to be allowed the freedom to go where they think they should go, and create strategies for particular banks based on their capabilities and their potential. This is a process that is underway. I think together with the process of cleaning up the banks, when both these mature, my sense is the strength of the public sector banks will be enhanced tremendously, and they will be very effective competitors when clubbed with their existing strong branch network, the trust with which they held in the wider population, as well as the increasing reliance on technology in bridging various gaps. So in addition to the new entrants, strong banks like Federal Bank will have a variety of competitors from the public sector system also looking forward. But I'm sure it will be a healthy mix. Let me turn to technology and innovation. So competition is one thing to look forward to in the future from a variety of players, including our large public sector banks. Technology and innovation is also going to be something we will see much more of. Now, as a regulator, we have to be, on the one hand, somewhat conservative. That's what we're sort of known for. If we weren't conservative, there would be no speed breakers in the economy to slow down its propensity to get into trouble. So we have to be conservative, and we have to sometimes create a little bit of a bump in the road so that people don't go at breakneck speed. But at the same time, we have to be careful about standing in the way of needed innovation. And so, on the one hand, don't close your eyes to everything that's happening and cheer it on. Don't be the cheerleader. At the same time, ensure that what is important is at least experimented with. What is new is experimented with, and then take a view once you see some of the consequences of that experimentation. There is a Chinese saying, I've said this in other places, cross the river by feeling the stones. That is one step at a time. Before you take the plunge, feel if there's a stone there, and then step onto it. We intend the process of financial liberalization to follow that path. Not intervene too much early on until we see the development of a particular product or a particular technology. But once we see it roll out, once we understand it better, before it gets too big, figure out what the appropriate set of actions should be. So for example, lots of new entities want their customers to have their ability to make payments quickly. And so we've allowed small value card payments without two-factor authentication, provided the entity that wants to offer this is willing to take up some of the risk in case somebody misuses a customer's card. So if they can bring in transaction monitoring structures which prevent excessive misuse of that small value transaction, we're happy to allow them to issue cards to their customers which have only one-factor authentication. Now, there are technological ways to solve the issue of financial security, of financial safety, and we're very happy to see them emerge and work with entities that want to bring those in and use those kinds of technologies to further the customer experience and make it possible to do things without tremendous hassle. My wife, who's sitting there, is always trying out new technologies and gives me a sense of how complicated the Reserve Bank sometimes makes things for users of new technologies, so we have a check and balance on that, which is domestic. So broadly, our philosophy is to allow innovation in institutions, instruments, and practices, so long as we don't see a clear and present danger. We may see one down the line if we understand the product better, at which point we will intervene to mitigate that. We may start worrying more when products explode, because exploding products may have systemic consequences that sometimes come to the fore only when they grow beyond a certain size, such as, for example, you remember the subprime mortgage issue. But at the same time, we have to be tolerant of experimentation. Let me describe 2 or 3 new structures that are going to come up over the next few months that will be very interesting. one of the most awaited structures is the Unified Payment Interface, which NPCI is coming out live with, which when fully rolled out will essentially allow anyone to make a payment to anyone else with a bank account simply via mobile and a unique email-like address. So you just need to know the email-like address of the person you want to send money to, and you can send it, and it will deduct your bank balance and credit that person's bank balance. Can be done very, very simply. Will allow tremendous flexibility in transfers. This is something that is coming in a few months. We also have licensed 3 trade receivable exchanges. These are essentially entities trying to make it easier for small businesses to get finance quickly. If you're a small business entity lending to, say, a large public sector entity, you're supplying, shall we say, steel rods. You've made them at high cost, you've incurred the working capital cost, maybe 20 lakhs, and you supplied the rods to the public sector firm, which pays you maybe after 4 or 5 months. In that period, your 20 lakhs of cost is locked up because you get no payment, and you got to go to the bank and say, finance me some more because this is locked up in working capital advances to the big bank, to the public sector unit. What the Trade Receivable Exchange does is make it possible for the small entrepreneur to get his money back quickly. Essentially, once you've delivered your goods to the public sector will accept your goods. You will take that bill to the Trade Receivable Exchange and say, I have delivered 20 lakhs worth of goods, and the public sector firm has promised to pay me after 3 months. The Trade Receivable Exchange will then sell that bill on the exchange. Somebody will buy it who wants the ability to deploy their money for 3 months. At the end of 3 months, they'll go to the public sector firm with that bill and get paid back. The beauty of the Trade Receivable Exchange, now many of you know this kind of banking already exists. The beauty of the Trade Receivable Exchange is automates everything. And so this sort of thing can be done at small transaction cost, and people will get paid earlier on. That is important. As also the public sector firm has an incentive to pay on time because its its payments are registered on the exchange, and its timeliness is also an important part of its creditworthiness. We have licensed 3 trade receivable exchanges which will be starting up soon, and I would urge a variety of financial players to start focusing on how they can work with the Trade Receivable Exchange to make it possible for small companies to get finance. The third development that we're watching is the alliance between internet marketplaces and financial firms. As you know, on these internet marketplaces, there are a variety of ways of making payments. But the beauty of it is that as you monitor the payments going to a merchant, you understand something about their business. How liquid it is, how many sales there are, in this case verified sales because they're going through your marketplace. There's a lot of information that can be captured in this particular market, in this process, about the nature of the borrower. And if that is so, the marketplace can then provide the information for a financial firm to make a loan to that entity who is selling through the marketplace. And that loan can be monitored intensively because you know the cash flows that are going in through the marketplace. So my hope is that we will see more of these alliances. As they emerge, we will also have to understand what kinds of risks they pose. But I think there's a tremendous opportunity for our small businesses across the country. I keep bringing this up, the idea of the carpet seller in Srinagar, who can now display his carpets on the internet marketplace and get sales right across the world. The internet marketplace helps with the logistics once a sale is made of taking his carpet and delivering it to the right person. But in the process, it also learns about the nature of his sales, the nature of his customer delivery and his quality. And in that process gains confidence to try and direct a financial firm to make a loan to him. And in that way, we get a strengthening of our small businesses across India. Already we see, because of these marketplaces, in small towns, people have access to a variety of goods they did not have access to before. That's a fantastic development because of these internet marketplaces. But I would also like to see how finance can take advantage of it. Again, we have to make sure that this is a reliable and safe process. And what we're doing is watching it and trying to understand it better before figuring out how to move forward. Now, I talked about competition, I talked about innovation. Let me talk about financial inclusion, which I already started addressing. You know, with the Prime Minister's Jan Dhan Yojana, much of the excluded population now has an account, and the government is moving more and more to giving direct benefits through these accounts. We still have the last mile problem which we are trying to solve, and which is that even though people have accounts, it still takes time for them to walk across to do operations and transactions in that account. Now, increasingly, technology will take care of that, but I also believe that through business correspondence, through payment banks, through point of sale machines, we will find a way to traverse that last mile and to make sure that every financial household is included. So I think on the payment side, we are making advances. On the cash and cash out side, we're making advances. And I believe that's the first step towards including somebody in the financial system. Give them access to payments and cash. The next step, I think, is to encourage savings. We have to give them a variety of savings products. We have to give them a sense of how to manage money, people who haven't had access to the formal financial system, and move them to a variety of products from savings to insurance and others. Essentially what I'm arguing is we need to get them to be financially savvy before tempting them with credit. Unfortunately, the process of financial inclusion sometimes always seems to revolve on the issue of how do I get credit. But credit has to be the last step in the process of inclusion, which starts with first, can I get access to cash? Do I have ways of taking cash and putting in cash? Can I save in an effective way? Do I know what interest rates mean? Do I know how the burden of interest can build up quickly? Do I understand what insurance means so that if there's a calamity, I'm not forced into complete destitution? Once I know all this, and once I have the benefit of some hand-holding from people who know how to manage credit, how to manage businesses, at that point, make available credit. If we follow the other step, first making credit available, unfortunately, people sometimes have the tendency to overborrow, as we've seen in some situations. In a sense, this philosophy of first savings and then credit is a philosophy behind the self-help groups that have been started in such a tremendous way in this country. It's something that could extend to small business finance also. And my hope is increasingly the new institutions that are coming in will serve not just as sources of credit, but sources of hand-holding for the small businesses that are starting up. Because small businesses need much more than just credit. They need to know how to manage, how to go forward. Now, as far as inclusion goes, I think one of the major interesting possibilities comes from unique IDs. As you know, with Aadhaar, that is now almost universal in this country, everyone now has a unique ID which then becomes a source of collateral in borrowing. As my colleague Mr. Mundra says, when he used to make loans to students or to others on the basis of Aadhaar, he used to say, this is a collateral-free loan, but I have your Aadhaar number, default on this loan if you want this loan to be the last loan you ever get, right? Essentially, once you have a unique ID and you borrow on that basis, you have your good name as collateral. And if you default, that collateral is lost. So the beauty of a unique ID like Aadhaar, which is hard to replicate, etc., is that it gives every Indian some collateral, their good name, because that name cannot be falsified, cannot be replicated elsewhere. It gives them the opportunity to access credit. Now, I understand that Aadhaar is under some legal scrutiny, and I also understand that the Supreme Court is looking at it, but the government is also looking to find ways to clear the legal cloud. But my sense is once that cloud vanishes, Aadhaar can be a very effective way for financial inclusion with products ranging from simple loans to individuals to student loans. If I can track a student over his or her entire working life, I will be much more willing to make loans up front and to build in a lot of flexibility about loans. Those loans could be tied perhaps to the income streams that students get. The loans could have moratoria period depending on whether those students are going away for further studies or not. You can have much more customized loans once you have a clear sense of ID and once you have the information associated with that ID. But while we have this with individuals, we don't have this with firms. I understand the government is now looking at unique IDs for firms based on their ownership, etc. But if we have unique IDs for firms, we can do the same thing for firms going forward in a way that will make credit much more easily available. More broadly, I think in this new world, we have many sources of information. We need to bring them together in our credit bureaus such that when an individual wants to divulge information to a lender, they have the capacity to divulge a variety of sources of information which reflects their credit worthiness. We also have technologies which reduce costs. A number of banks, including federal, now have loans which can be made almost instantaneously because they aggregate the information they already have with the information in the credit bureaus and based on algorithms figure out whether the entity is credit worthy. So in order to make this widely available, we need to improve our connectivity, our information systems, our credit information bureaus, and our collateral registries to make it much easier to give these kinds of loans. Before I finish on financial inclusion, I think one of the most important assets in this country is less usable than it should be, and that asset is land. We have tremendous amounts of land which would benefit from much clearer definitions of ownership, much better digital mapping, and clean records, which would then allow anybody who owns that land or who is renting that land and has a patta confirming that they're a tenant to be able to access financing against that land. Today, to some extent, because of murky land records, murky ownership, the ability to access financing against land is less than it could otherwise be. So digital mapping, better land records, some states are already doing it, more need to do it in order to expand access to financing. Now you do all this, you enter the financial system and you have bad luck. Distress is an inevitable part of a free enterprise system. Failure is not a bad thing. If you are a risk taker, it will happen almost surely if you take a number of risks. What is important is when failure takes place, we have to have a quick way of resolving the failure, and if the enterprise is viable, put it back on track. If the enterprise is not viable, liquidate it and close it down. Now, both are important. Putting it back on track when it's viable is extremely important because there are people whose livelihood depends on it. And if it's not put on track, if it's just stagnates, it also hurts the lender, as you well know. Fortunately, we now have a bankruptcy code which is working its way through Parliament. The importance of the bankruptcy code cannot be understated. When it comes in, I'm hopeful that the legal apparatus that is needed to work it will come in quickly, and we'll be able to resolve issues of distress much more rapidly in a way that balances the interests of the creditor with the interests of the borrower in a fair and effective way. That will also make it easier for new sources of finance to develop, like a strong corporate bond market. But I think the bankruptcy code is also important not just for resolving distress and putting projects back on track, but also creating exit. A number of government officials tell me about these industrial parks which are full of empty sheds. They're full of empty sheds even while businesses are looking for space to start new businesses. And the empty sheds are there because some business used to be there, it died, but there's no way of giving it an honorable and peaceful death. It's a living dead entity because it is not allowed to go out of business until the legal system actually does that. I think with the new bankruptcy code, hopefully we can put a lot of these zombie businesses out of business and clear space for new entities to come in and occupy that space. Finally, as we talk about improving the financial system and bringing more people in, we have to make sure that people are protected against unfair practices, especially when a whole new set of the weaker segments of society, the less sophisticated segments of society come in. Recently, the RBI has put out a Charter of Consumer Rights. After public consultation, there are 5 basic principles which we've put out. And bank boards have been asked to put in place frameworks that ensure those rights are protected, including in many banks, which are of reasonable size, creating an internal office of ombudsman. This is going to be, this is in many banks, a banker who knows the industry but has been hired from outside, who looks at the disputes that are going on between the bank and the customer internally and pronounces in a way that is seen as unbiased and fair by customers. Now, this has been in this Charter of Consumer Rights, and its operation has been around for a few quarters. We will now study best practices across banks, and as I said, we will then, after studying what has happened, take a view on what regulation we need. Now, we also need to be careful that customers, even the sophisticated ones, are not preyed on in this very competitive environment. We often hear concerns about mis-selling, not just of banking products, but also about insurance. It's important that a central bank protect the public against rampant mis-selling. We're going to up the frequency of our incognito visits by people who check that the selling that is being done by banks is appropriate and is consistent with the norms of fair practice. There are also many banking structures which are important, but which need to be functioning. A number of times I go to an ATM, it's not working, and I'm sure some of you have had that experience. What should be the functionality of ATMs? What responsibility do banks have to make them function to a greater rather than lesser extent? Those are some of the kinds of things we need to do, we need to look at to make sure the system is working well. And then finally, there is the fly-by-night operator. And as this state well knows, this can be a menace, not just to the formal financial system, but to the customer who is misled. Increasingly, we have strengthened the state level coordination committee across states. This is a committee which is chaired by the chief secretary and has in it all the regulators as well as law enforcement agencies. We bring to this committee information based on our market intelligence on fly-by-night operators, and I would urge the public to send information to us if you know about these practices. And then in this committee, action is debated. Many states have strengthened their protection of depositor acts, and that will also give the authorities the ability to nab these fly-by-night operators before they do real damage. Now, along with customer protection, we need increased financial literacy. The best form of protection is when you protect yourself, when you don't need somebody else to protect you. And again and again we find that higher education is not enough to have a good sense of what is good financial practice and what is not. I'll give you an example. I'm sure many of you who have an internet account must have received an email from me saying that the RBI has concluded a pact with the British government or with the IMF or pick some other high-sounding authority, and that the pact is about gold that was found on pirate ships off the coast of Cochin, and that gold has been sold and the proceeds will be returned to deserving citizens like you. So, in return for a small transaction fee, usually about 20,000 rupees, the email says that I, from the Reserve Bank, will be very happy to send you a demand draft for 50 lakhs into your bank, to you, if you give me an address or direct wire transfer to your account. These emails are incredibly persuasive, I have to say. They're very well written. There's usually the Reserve Bank chapa there, the tiger. Some people say it looks like a dog, it's actually a tiger. Tiger and the palm tree, that's there. But you might want to pause a minute and think, if I have 50 lakhs of your money with me, why do I need you to send me 20,000 for transaction fees? Why don't I send you 49 lakhs 80,000 into your bank account instead of asking you to send me 20,000? Unfortunately, many people don't ask that question, and my office gets phone calls from fairly educated people saying, what happened to my 50 lakhs? Truth is, if you look at every RBI document, email, website, it says, we do not ask you for your money. We have plenty of money, we actually print it. So we don't ask you for your money. And the central theorem of financial literacy is there is no such thing as a free lunch. It's important that you remember that if somebody is offering you a free lunch, especially a stranger, be very, very careful. Wonder what's in that lunch. And in the context of financial investments, this can be restated as there's no return without risk. If somebody is promising you extraordinary returns, 28%, 30%, with absolutely no risk, and somebody tells you, I did it, I got my money multiplied 3 times, look at them with great suspicion, because sometimes they may have got their money back, but you may be the fall guy who doesn't get his money back. That's the nature of every Ponzi scheme. So I could go on, but what I wanted to just conclude with is times are turbulent, and a lot of authorities across the world are going out to say, look, fundamentals are broadly sound. These are financial markets worrying about financial markets. That self-referential jitter can get quite extreme. Unfortunately, as Franklin Roosevelt once said, in the midst of the Depression, the only thing we have to fear is fear itself. That's probably something worth saying every time financial markets get into a dizzy as of now. But I want to emphasize the fact that the opportunities in the financial sector, every part of our banking system, are tremendous. I can see that just doing what is already on the cards, not even talking about the tremendous innovations that will come which we don't know about, but doing what is already on the cards can facilitate growth for many years to come and can be a source of great profitability to the financial system as well as to the economy. Of course, the true engine of growth is ultimately the people of the country backed by good policies from the government. My sense is that we are well on our way to many years of strong growth, and I think the financial sector would play a strong part in facilitating that. Let me stop here. Thank you very much.
Thank you so much, sir, for that enlightening lecture. I hope all of you have enjoyed it. He has stressed on innovation, financial inclusion, steps for improving the financial system, and also the need for increased educational literacy. He has also stressed that technology could be helpful in reducing the cost and also to do things without much hassles. Thank you, sir. It was indeed an illuminating lecture. Ladies and gentlemen, we have 10 minutes for an interactive session. Our chief guest has approved 10 minutes. We have our representatives out there with the microphones. They will be coming to you, so please raise your hands and you can ask questions. Please introduce yourself before you ask your question, your name and your designation.
Welcome, Chief Guest. My name is Meridien. My question is, during 2012 or even before, up to 2014, the crude price was 100 rupees per barrel, under dollar per barrel. Now the price is below $30. Why government and this oil companies are not sharing the profit with the common people? Please,
your question, why all the oil price decline has not been passed through to the common man, that's a question better posed to the government. But let me hazard a guess. The government, of course, wants to make sure that some of this oil price volatility is smoothed out. If you believe that prices can get too low and then shoot up once again, you don't want people to get accustomed to the, to start expressing a much higher demand, get accustomed to the very low price, only to be hurt when it goes up. And that's why I think some smoothing out through the process of taxes. Remember when prices went up, taxes were cut, and now perhaps, I'm just hazarding a guess, I don't want to speak for the government is trying to smooth out the process of the price movement.
I am Dr. Abraham. I have a question to His Excellency Dr. Raghuram Ji. The same podium. 2 weeks ago, Dr. Subramanian Sami, everyone knows as an economist and a politician, was speaking about the interest policy of the Reserve Bank. He in fact was saying that they have a very aggressive interest policy. This he explained in the context of why they are opposing the entry of multinationals like Walmart. He said that a multinational like Walmart or even our Lulu gets capital or resources for very low interest like 4%. Whereas the mom and pop store here or a small industrialist like me or a trader like me gets interest only at 15 person. For the capital I like to pay. He called it that the Reserve Bank and its governor, I am sorry to say, has a crazy interest policy. So I am looking for a tomorrow, perhaps where I can get my capital or my working capital for about 4 or 5%, so that I will get a level playing ground as with my
hear your
like
question.
the
I hear your
multinationals
question.
and others. Can
I
you
hear
please
your
comment
question.
on that?
I hear your question. Why don't you poll the audience and ask if anybody would be willing to lend you at 4%? I mean, then somebody has to save in order to lend to the businessman.
Yeah, the Reserve Bank
With the interest
reduce
rates
the
today,
interest.
please hear me out, I heard you out. I heard you. With the interest rate today, ask how many letters I get from pensioners saying interest rates are too low given the inflation, right? So there's two sides to this issue. You want interest rates at 4%. Ask anybody, ask yourself, will you be willing to put a FD at 4%? No. So if you're not willing to lend, tell me who's going to lend to you? You have to find somebody to lend.
I'm Jaydeep Mehta, international analyst. So my question is, India is a growing economy as per the data provided by the government. And we are having the most eligible economists as our Reserve Bank governor. Still, the rupee is hitting historical low against the major currencies, and the banks in general are in deep trouble. Why this anomaly?
First, there are two separate issues. I don't think our banks are in trouble because of the rupee. Second, not all our banks are in trouble. There are very strong banks in the system. And the banks that have some balance sheet issues have the potential to resolve them. Government is behind them, Reserve Bank is behind them. This is a problem we will fix without any doubt. And I have no doubt at the end of this process, the franchise value that they have will come to the fore in full-fledged manner, and they will be strong, healthy banks. So I don't think this is a permanent issue. On the issue of the currency, I mean, what most people look at is the value of the currency against the dollar. The dollar has been one of the stronger currencies in the world. And so as the dollar has appreciated, the yen has depreciated, the euro has depreciated against the dollar, if you take a span of a year and a half and you look at it. And we have also depreciated against the dollar, but not as much. So what we look at is the real effective exchange rate. If you look at the real effective exchange rate, it's actually flat. In other words, we haven't really depreciated in real terms against global currencies. We have been very, very flat over the last couple of years. So, bottom line is, don't look only at the dollar, but also remember that if we are a country with high inflation, that goes back to the previous gentleman's question on interest rates. Why interest rates high here but low elsewhere? Elsewhere they have deflation. So a 1% interest rate itself is very high there. We have inflation of 5.6. Yesterday it came out 5.69 CPI inflation. So if at 5.69 inflation you want interest rates at 4%, that means every person putting his money in, right, will expect to lose money in real terms over the course of a year. You can't expect people to save at those rates. Similarly, the exchange rate, a certain amount of depreciation is built in because of inflation differentials. Until we bring inflation down, and that is our objective, to bring it down to world levels, there will be a certain amount of depreciation which is necessary to ensure we don't become uncompetitive. But our intent is not to depreciate the rupee in a steady way or anything of that sort. Our focus is on bringing down inflation so that people will not have to ask why is the rupee weakening.
John Morris, Chartered Accountant. So actually, like Satyam episode, we should have some mandate. At that time, there is no bankruptcy rule or anything. But beautifully, government converted the failure into a success. Same way, all the assets, as you told, There are so many vacant sites there. People are spending a lot of money other places. Well, with some kind of ordinance or anything, wherever underutilized infrastructure. In Tamil Nadu alone, we did a small research. Every year, GDP loss in engineering colleges alone is 8,400 crores opportunity loss. People are losing. Now everybody is going out. In India, Tamil Nadu 42% is higher education. Elsewhere it is 5%. Average is 20%. You send the people from other places to transfer here. Some method. All the banks are now bleeding with the education sector loans. Something we have to do, sir.
I fully agree that if we have unutilized assets, we should find a way to utilize them. I'm not an expert on education, so I don't know what the policy answer is, and I'll No, I think the broader point you're making is a very valid one, which I completely agree with. Whenever assets are stressed, we should work them out quickly and put them back on track. That's the whole point also of this effort that banks are making today. It is to clean up, because if you delay it longer and longer and postpone the resolution, the asset gets weaker and weaker. So I think this is an effort which we need to engage in throughout the country, and I think we'll certainly come out much stronger for it. So, is there a lady? There's a lady asking. Yes.
Good evening, sir. I'm a student. I'm an engineering student. I'm so happy I got an opportunity to ask you a question. I'm a dosa lover, and I'm so fascinated by your dosanomics, sir. You taught us to protect ourselves, and you taught us that lower interest rate with lower inflation rate is better than higher interest rate with higher inflation rate. Sir, but in real life, I have a query. When it comes to dosa prices, when the inflation rates go up, the dosa prices goes up. But when the inflation rates are lower, the dosa prices are not lowered. And what is happening to our beloved dosa, sir?
You have hit on another issue in economics, which is called the Balassa-Samuelson effect. Okay, you remember the great economist Paul Samuelson? He wrote a paper with Balassa, and the idea is the following. Bear with me for 1 minute. I'll give you this lecture on why dosas are increasing in price. The technology for making dosas hasn't actually changed. Still today, that person puts the maav on the tawa, spreads it around, and then takes it out, right? There has been no technological improvement there. However, the wages you're paying that gentleman, especially in a high wage state like Kerala, are going up all the time, because that worker can be used in much more productive areas where productivity has gone up, such as factory work, such as banking, where today that same bank clerk can service many more people because of technology. So what happens is that in an economy which is growing, and where there's sectors which are improving technologically, while other sectors are not improving their technology, the prices for the goods manufactured by sectors that are not improving their technology will go up faster. That's Balassa-Samuelson. You're seeing it in the price of dosas.
Vinayak Chatterjee from Feedback Infra, but I'm here as a very satisfied customer of Federal Bank. That explains why.
Did he put you up to it?
He did, sir. He did. He told me to say that. But the question I have for you is, at this very moment, there is a raging debate among economists in India about the method to take our economy forward, to rev it up. So should we be loosening our targets on fiscal deficit and go in for higher doses of public expenditure? in the absence of everything else that you're aware of? Or should we be proponents of fiscal rectitude and actually stick to the fiscal deficit target with whatever short-term consequences there may be, adverse or otherwise, to the economy? So, which side of the debate are you on, sir? And your comments on this matter?
See, it's so close to the budget, I don't want to start talking about the fiscal deficit. I think it would not be wise. All I would say is that broadly in uncertain times, how much weight you put on macro stability versus how much weight you put on trying to push growth a little more is something that you have to figure out as a country. As a regulator, as a central banker whose job is macro stability, I would definitely like more weight put on macro stability because we can see around the world the consequences of losing that. The effects on growth are much more severe if you lose macro stability than perhaps if you gain a little more through additional stimulus. But if there are wonderful projects waiting to happen with high growth rates, obviously we should not forego them. The key question is, are they there? Where are they? How do we invest in those kinds of projects? And can we already invest by shifting resources from elsewhere to those projects? But I mean, broadly, I think the government understands the issues and has to figure out how it plays this going forward in the budget.
Sir, good evening, sir.
I have one question, sir.
Excuse me.
Sir, I have one question. The interest rate charged by the bank on loans, they are doing it on a monthly rest. Whereas as a depositor, I am not getting the interest at the monthly rest. I am getting it quarterly. If it is asked for monthly, it is only at a discounted value. Second thing is that the public sector banks, their non-fund credit has gone up only by 3.5%. I have read the statement from you the other day. And is it because of the lack of demand for the credit, or is it a credit aversion from the public sector banks, who are controlling more than 70% of the portfolio of banking in India?
See, on the first question, I will hand the mic to Mr. Srinivasan. He can answer it. I presume he doesn't find it a big issue. Not too many people are demanding it, so he's not creating a product. He doesn't have one. But nothing in our regulations prevents him from giving even daily interest if necessary. So, on the second issue of credit growth, this is a very important issue, and my belief is really that for those who say wait, hope for growth to come back because more loans will increase the denominator in the bad loan to loans ratio, and that will be the way out. For example, that was what some people think happened in the early 2000s when our NPA ratio went into the 15-18% at some banks. I'm more skeptical for the reason that you just mentioned, that sensibly banks are becoming more discriminating about credit. I think this is actually a good development. Of course, private sector banks are growing quite fast in some of these very sectors, which is suggesting it's a differential pace. My sense is the public sector banks, as they deal with their legacy problems, will start moving to enhanced credit, and I'm hopeful they will be prepared at the time the economy's demand is also coming up. I have no doubt there's some truth to the statement there's not enough credit from the usual, there's not enough demand from the usual sources. But certainly we know small and medium industry is looking for more credit all the time. So there are some sources which want credit, but I would say let us ensure that we have the capacity by cleaning up the balance sheet, and then we can move forward to supplying that. Currently, the markets as well as the private sector banks are supplying that. Public sector banks will take over as they get more, confidence and capital. Capital becomes more available for them.
Good evening, sir. So of late there is a skepticism about the new GDP growth rates, whether the revised methodology or the base is reliable, and also what will be the rates as per the previous computation as well as the new one.
So I think as the chief statistician has said repeatedly, part of the skepticism comes from a change in the way we count it, that we're looking at value added.
And that has some differences. So a corporation which is not increasing its top line, but is reducing its costs tremendously. So it's not selling more, but the costs have come down tremendously. Its value added is going up. Even though the corporation complains it's not making more sales, its value added has gone up. Its profitability also has gone up. In fact, we see that in the numbers that we look at, that in fact, that is a fair description of a significant segment of manufacturing industry. Now that said, the places that are growing a lot are often in services. And again, when we poll people as to how do you think the economy is growing, they typically look at manufacturing numbers. And that's another reason why there may be some discrepancy. But I would say a third reason that there is some concern is because nominal GDP growth is not that strong. And it's because the GDP deflator is negative that the real GDP growth is higher. And that also is a source of some bother because traditionally we've had very high real GDP growth, but on top of that inflation, which has led to much higher nominal GDP growth. I have no reason to believe that the statistical office is not doing the best job it can. I think over time we will understand every detail much better and we'll become more familiar with it. But I don't think there's anything to say or to point at this is where you're not doing your job properly. We've had lots of discussions with them. So I think they're doing the best job possible under the circumstances.
Yes, ladies and gentlemen, one more question. This will be the last.
Good evening, sir. I'm Dr. Raman. My question is representing the gray hairs, senior citizens. Though you may say, please ask the government, I'm sure you are the Brahma of fixing up the interest, the bank deposits, and the senior citizens' interest rates. I please appeal to you, sir, to fix up a higher interest rate for senior citizens, especially persons like me, a retired executive from a private company who doesn't get a single paisa pension. I am mainly dependent upon interest from the banks, where the interest rates have been slashed down. So for senior citizens, I request you to please consider a higher interest rates with interest only we can live.
So, sir, I would ask you to talk to the gentleman who asked a question earlier, and perhaps you can negotiate some policy. But whatever policy you negotiate, don't ask me for an interest subvention in the middle. I only transmit policies. So please.
He is a friend of mine. He will not consider anything. I can only ask you, sir.
There's a lady there. Last question.
Sir,
actually, the lady was.
That would be the last question. I think she can ask the question now.
Good evening, everyone. My name is Yamuna Menon. I am a first-year law student at National Law School of India, University, Bangalore. So, most of the recent financial transactions are in the form of loans, buying and selling securities, and there were reports of capital inflows, outflows after the US Fed rate hike. So, do you think we are living in an artificial or imaginary economy rather than the real economy?
No, I mean, yours is a very good question, and unfortunately, these movements up and down are not, you can try and ignore them for a while, but if they persist, they also tend to affect the real economy. So, my advice to my fellow central bankers across the world has repeatedly been, let us not mess with the prices, because then we create some of these this volatility, which eventually could come back to hurt the real economy. They have other compulsions which they have been trying to meet. So as a result, I think we have been experiencing some of these ups and downs. But let us hope going forward we will have sensible policy.
Thank you, sir.
Thank you, ladies and gentlemen. We are concluding the interactive session.